So Lemonade has January 15th, 2027 options now available. Options that are expire more than 2 years out into the future. I want to give a few thoughts about these options. Nothing in my channel, nothing in any of my videos is personal financial advice. And especially want to reiterate that on a video like this, where we're talking about options, which can obviously carry a greater degree of risk, but potentially a greater degree of upside. But really want to stress that, hey, what you do in your own portfolio is totally up to you. I'm just trying to explain some of how I think about these things. And for my own portfolio, I probably wouldn't buy a large amount of options. Probably if I bought any, it would be a small amount. You know, maybe it's 1% of my portfolio, maybe it's a couple percent, few percent. I would probably land somewhere in there. Pretty conservative investor, almost all entirely in shares. That's just me. That's just my own kind of way of thinking, but I'll break down sort of how I view the opportunity here in this video. So you can see some of the pricing here and the last prices for different options out in January at various strike prices. These just came out yesterday, so I would assume we're going to see some fluctuations in the prices here, and maybe there's a bit more tightening between the bid and ask spread. But you can see a little bit of how it's priced in this moment, or at least right now. The way I'm thinking about this, I'm going to plug in one example of a $35 strike price. $3.60 was the last exchange on that one. The way I'm thinking about this is I'm graphing this out and I'm saying, okay, right now the stock's worth, let's look at the red line only. The stock's worth 18 bucks a share. So if we plot this on a graph and say, hey, what's the future share price, you know, in January of 2027? What might that share price be? And then what's the multiple return on my investment for that share price? So for right now, the share price is maybe around 18 bucks a share. So X being your the future share price divided by 18 would give you your multiple. So hey, if it goes to 36 bucks a share, you're going to be about 2x return, right? If it goes to $80 a share, you're going to have 4.5x return on your investment. Of course, if it goes down or it goes to zero, you get nothing. Or if it goes less, you have a fraction of what you started with. But this shows a bit of sort of that, hey, if we believe Lemonade's going to succeed, they're going to become cash flow positive, adjusted EBITDA profitable by that time frame, which I'll note in their Q4 2024 letter, they did say we are on track to turn cash flow positive during 2025 and adjusted EBITDA positive during 2026. You'd think by the time this is occurring, January 2027, they should be adjusted EBITDA profitable. So what might they be worth? Hard to say. We'll get to that a little bit in the video here, but you can kind of see what the possible multiple return would be on your 18 bucks. But now if we look at, say, example, $35 strike price, and say you paid $3.60 for that option. So I have that plotted in here to give your next multiple X return. Hey, there's the new price per share minus your strike price minus what you paid for it divided by what you paid for it. So you get an intersection there of about $48 per share. And also intersection at zero here where the option, you know, becomes not worthless over $38 a share. And then between the $38 a share, you know, $48 a share, you would have been better off if you just simply bought shares. So if you think by, hey, January 2027, say we think Lemonade thesis comes true, say we're all correct in our thesis, but maybe not the magnitude. We're not sure if the magnitude is correct or not. We're not sure where it is. But, you know, you have to kind of think if it's going to end up less than $48 a share, you might as well just buy shares. If you think it's going to be over 48 bucks a share, then buying these options would be more valuable, because maybe it goes to, say it goes to 80 bucks a share, and if you just bought shares, you're going to have about 4.5x return, but if you had bought the option, you'd have more like an 11x return. So, you know, not quite 3 times more of a return on your money on top of what you already had. It's pretty significant. If it goes to, say, even like 120 bucks a share by that time, you'd have normally just shares, still a phenomenal return, 6 or 7x return over that time frame. But 120 bucks a share on the options, you might be you're looking at more like a 22x return. So really significant, this greater upside potential if it goes over, if share price is higher than $48 a share. If you think if it's less though, you're actually doing worse. And if it's in this point, maybe it goes to $32, well, the option's not worth anything. But if you had just bought shares, you would have at least doubled your money. So down here, obviously anywhere down here, just buying shares is a much, much better option. But if it's in past that $48, well, now the upside is worth it. If you look at a few other strike prices, like say $27 strike price or $20 strike price, and of course you spend a little bit more, $5.30 or $6.80, say, depending what that price for those options are. You punch those in a couple more lines, make this a little more messy, but you can see it's all kind of converging around this, similar to this $48, $50, somewhere in their range is really the critical point. You're thinking, hey, by 2027, start of 2027, will the share price be more than that or less than that? That's kind of helps you decide, say, is this worth it or not? And of course, I'll turn this one off. These two, like say we look at $20 strike price and $6.80, you can see versus say a $35 one. That one will toggle off and on a little bit. Obviously, if the lower strike price, you're going to pay more for it. And there's sort of less of this downside risk where, hey, even if it only goes to $37 a share, you might still be making some money on it, rather than the other option. You might be, be worthless, but then the upside's not as high, of course. So now, instead of at $100 a share, instead of going to 17x, you might be at a 10x, or instead of buying shares, you'd be 5.5x. So it kind of shows you that relative difference. So if you're wondering, like, what would be the right strike price to buy, again, I don't think there's one correct answer. I would probably lean to the higher strike price, so that you kind of, with a lower amount of, like a small amount of options at the higher strike prices, so that if you do succeed and it's sort of like wildly successful and Lemonade goes to $180 a share, and it's like, well, now on those shares, you did like a 40x on those shares instead of just a 10x, but you have that sort of much higher upside. That would be kind of my leaning, to sort of lean into that, and then knowing that, hey, there is some chance these might become worthless. So I'm not going to go really, really heavy into it. That would be at least my thinking. And then if we look at just comparison, like a January 2026 call, so we flip to January 2026 and say, like, for $35 strike price a year earlier, it's trading for less, obviously, $1.95. So I've got that one in here. I'm going to turn that green line on. Obviously, you only have to get a $41 a share or higher to be worth it, but now we're talking a year sooner. So a whole year sooner, the start of 2026, or pretty much the end of next year, do we think we're going to get to $41? I'm just not. I would be hesitant myself to buy those calls, because it just seems very difficult to predict how the market's going to react on a shorter horizon like that. So I would rather pay more, have less upside, follow the blue line in that sort of potential, because I think by 2027, there'd be a better chance of that kind of upside of being, over $50 a share. Because again, they said here, they're planning cash flow positive next year and adjusted EBITDA positive during 2026. So I think by end of 2026, the outlook, say they deliver on this, which I think they will, it should be a very positive position for the stock. And in my mind, being over $50 a share by that time frame, it seems pretty likely that that's going to happen, though of course nothing is certain. And I've done lots of valuation in my own Lemonade model, but I thought for this video I'd try something a little different, just to sort of showcase this. Say, hey, ask ChatGPT what might Lemonade be worth, without telling it that I'm talking about Lemonade. But if it said, hey, an insurtech company with global ambitions, and I'm saying, hey, it can grow 20% or more annually for decades, even what I said. It's improving its profitability, and I asked ChatGPT, what might a company like this be worth now? I'm assuming at the end of 2026, so more than 2 years away, they have $1.5 billion in premium. That's only about, say they end this year at $950 in premium, and they do that. If they grew 25% a year, you're about that range. So say they do 25% over the next 2 years' time, they're at about $1.5 billion in premiums by the time those options would expire. And then I'm telling ChatGPT, hey, they're 5% operating margin profitable at that time, and they're going to grow to 15% profitable over the next several years in operating profit. And I'm saying, hey, they're going to grow the top line 20% or more for almost indefinitely, for at least maybe even for years, maybe even decades. So ChatGPT says, okay, so maybe they make $75 million now. This is, in adjusted EBITDA profit we're talking about at the end of 2026. And then saying, hey, that grows to 15%. So in maybe, in a future date, that's worth more like $225 million, that same amount of premium. But then say premiums are growing 20% per year. So it does a little bit of math here. Premiums, 5 years out from that, so it'd be like seven and a bit years from now is what this is talking about. Maybe your premiums are like $3.7 billion, right? If you're growing only 20% a year, and arguably, I feel like they could, over that span, 5 years, they could probably even grow faster than that. But say they go with that $3.7 billion operating profit, and say they're making 15% operating profit, you're talking $560 million in operating profit. And then it talks about, hey, we could, for an insurtech company like this, it could be price to earnings ratio or price to premiums ratio. It even says, it references Lemonade here, high growth insurtechs like Lemonade often trade 10 to 20x revenue. That's probably, that'd be old data now, but depending on growth margins and market sentiment. So like anything I've said, even the fact that ChatGPT points this out, like we're trying to come up with a possible valuation for Lemonade a couple years out, right? And it could be wildly different than what we're trying to predict. And if anything, I think since the sentiment's quite low still for Lemonade, if anything, in my mind, the upside is the option that's there. Doesn't mean we're going to get it, but that to me is what it feels like. So it says traditional insurance companies trade more like 1 to 2x premiums. So, however, given the global ambitions, potential for multi-line offerings, we'll assume higher multiples in your scenario. So they just say, this 2 to 4x premiums, they say current value 1.5, might be $3 to $6 billion for the fair value now, and future value of Lemonade might be in 5 years' time. This is sort of your like 2026 price. It'd be $3 to $6 billion, and then in 5 years' time, or end of 2026, 2027, when those options are, and then in 5 years' time, more like $7.5 to $15 billion. Or you base it on earnings, 20 to 30x times those operating profits, then you're talking more like, hey, 11 billion to 16 billion. So it says in conclusion, maybe they're worth 3 to 6 billion now, maybe they're worth 11, 17 billion over the next 5 years. And so I assume, what if, in the future there's about 70 million shares now, or just over 71 million shares outstanding. I said, what if they have 75 million shares and in those five years time, and a 12% discount rate back to present value. So future valuation, it says, again, 11 to 17 billion, takes a discount rate of 12%, and gets, present value maybe $6 to $9 billion right now, and a share price. It uses the 75 million shares. You could argue you should use the current share account, but this at least counts into some of that. This accounts for some of that dilution. So it's saying, hey, maybe present value is more like $85 to $128 a share. It'd be a good share price. So of course, if this happens, it's a no-brainer. You should buy the options. And if you go like it showed here, 80 to say $130 range. So you're playing in this range here where you're at, instead of 4.5x, you're at that 11.5x, and instead of 7x, you're at a 25x return at the higher range if that comes true over that time period. Of course, that's where the risk is. That's where nothing is certain. We don't know that for sure. But in my mind, I mean, I think these are reasonable assumptions. I think we've seen in other videos, even right now, you could say lemonade's worth $80 to $100 a share right now. So to say, hey, will the market value that and realize that if they prove they're just EBITDA profitable, if cars rolling out and they're gaining car customers, home customers, just from their 2-3 million customers that they have by that time, and they're converting from their pet and renters that they're still dominating in. If that's all the case and the market sees that and likes that, I think it could definitely achieve that, and who knows, maybe even higher. Maybe you should have these sort of wild scenarios where they go to $200 a share, and you follow this line, and it's like a 44x return on your net investment from now. So that's why in my mind it's probably worth a little small position, but given still that you're always uncertain, you never know exactly what the timeline could be. For me, I wouldn't invest heavily in the options, but I know some people would. That's totally awesome, and if it succeeds, I'm pumped for that. And other people would say options aren't for me whatsoever, and I'm not going to touch them, and I respect that too. And thank you so much for watching. Remember, it's in the bag.